The infamous EKI Energy is back in the news again. And guess the reason this time? It is the same as the last time. Issues with the statutory auditor. The management of EKI Energy has decided to remove the statutory auditor. And the reason mentioned for the auditor's removal is quite funny. Please stay tuned to understand what is the current situation of EKI Energy and what dangers it poses to retail investors. Namaste and welcome to Retail Investing. There was a resolution to remove the audit firm named Walker Chandiok and Company before the expiry of its term. The resolution received 100% against votes by public shareholders. But the promoter group controls 73% stake in the company. Hence, the resolution was cleared. However, as per rules, the auditor cannot be removed until the union government approves it. In a filing, EKI Energy has said that the auditor was removed on grounds of unreasonable fee hike and delays in the audit of the quarterly results for the quarter ending March 2023. However, a third-party governance firm named Stakeholder Empowerment Services has said that EKI Energy did not provide the auditor the data that was required for the audit. Walker Chandiok and Company is a well-known international audit firm. Few months ago, they accused EKI Energy of accounting fraud. The company was accused by the auditor of showing some random expenses as assets. That means money was taken out of the cash reserves to buy assets, but the assets could not be found. This is typical of the balance sheets of shady companies. In the last 3 years, 2 more auditors have resigned, citing preoccupation. Preoccupation simply means that the auditors were busy with something else. That sounds like an excuse to get rid of EKI Energy. And after them, the company is attempting to remove Walker and Chandiok before the expiry of its term. The governance firm SES has demanded that SEBI must order a forensic audit of the company. The purpose of forensic audits is detecting frauds. These kinds of allegations on a publicly traded company by an auditor and a governance firm are rare. If you look at the shareholding pattern for the June 2023 quarter, both foreign and domestic institutional holdings have come down to zero, and retail shareholding is at an all-time high at 26.35%. This makes it quite clear that retail investors have been trapped in the typical manner. Stocks which get promoted on TV and social media are very dangerous. Soon after the IPO was launched in 2021, the CEO of EKI Energy was doing frequent interviews on big news channels, indirectly encouraging investors to invest in the company. And in the next 8 months, the stock price went from 40 rupees to 3100 rupees. And then the massive crash began. That was the game plan. Sometime in June, there was a sudden increase in volume and the share price crossed 600 rupees. The daily volume crossed 2.5 million shares. I tried to find out what was going on and found this. A small firm named NK Securities Research purchased 2,37,000 shares at 581 rupees and sold at 582 rupees on the same day. So that was intraday trading. I'm sure these sudden price changes and increase in volumes must have got attention from retail investors. And even more retail investors may have got trapped. Mr. Saurabh Mukherjee of Marcellus wrote a wonderful book named The Unusual Billionaires. In the book, he mentions that good CEOs always stay away from the limelight. This is very true. You may have noticed that all the CEOs of India's best companies like HDFC Bank, TCS and Asian Paints can never be seen in any interviews, and nobody even knows their names. They secretly keep working and create wealth for shareholders, while some CEOs use publicity and promotion to destroy shareholders' wealth. For me, there is no point in doing fundamental analysis of EKI Energy because the auditor has accused them of reporting bogus revenues and profits. Their return on capital employed is 236%. Compared to that, the return on capital employed of Reliance Industries is only 10%. Think about it. If this carbon credit business model of EKI Energy is capable of generating such high returns on capital, why does not Ambani start a carbon credit business? After all, 236% is so much better than 10%. EKI Energy has a price to earnings ratio of 3.55. This makes the company look highly undervalued. You see, value is determined by profits and cash flows. If the profit figures are fudged, it is very easy to get a price to earnings multiple of 3.55. If you are looking for multi-bagger stocks and run a very good screener, EKI Energy is going to show up in your screener results as an undervalued stock. This is very deceptive. Make sure you protect your capital at any cost, because that is the first step towards creating wealth. Thank you very much for watching this video, and I'll see you in the next one. Don't forget to like, subscribe and share this video with your friends who are considering this stock.